I want to start today with a bit of a word association game.
Okay, I'm ready.
If I say the phrase automated trading or, crypto bot, be honest. What's the very first thing that pops into your head?
Oh, that's easy. It's a YouTube thumbnail.
Right.
Yeah, bright neon text, maybe a guy in front of a rented Lamborghini pointing at a chart that's just a straight vertical line.
Exactly. It just screams, get rich quick.
Right.
It feels like a casino, like the absolute Wild West of finance, where you're just as likely to lose your shirt as you are to make a dollar.
It's a healthy instinct to have, that skepticism. The retail space is just flooded with junk.
It really is. And honestly, when I first started going through the research for today's deep dive, that's exactly where my head was at. I saw automated execution, and I immediately put my guard up.
But this is different.
This is very different.
Yeah.
And that's the big but here. Today, we are going to flip that script entirely. We're digging into research from a group called NeoDataNet, and they're doing something that, frankly, I hadn't even considered before. They aren't building bots just to trade for a profit. They're building what they call Africa's first execution-level market observability infrastructure.
It's a mouthful, isn't it?
It is a mouthful.
But if you strip away all that jargon, what they're proposing is a really profound shift in how we should think about financial markets, especially in emerging economies.
It really is. They have this core concept that just hooked me immediately, and I think we should use it as our anchor for this whole discussion.
I think I know the one you mean.
Trading as a sensor.
That's it. That is the key metaphor. Trading as a sensor.
So let's unpack that right away. Because normally if I buy a stock or a token, I'm doing it to make money. The trade is the goal. Buy low, sell high. Simple.
That's the logic for 99% of the market. The trade is an act of value extraction.
But NeoDataNet is saying no. The trade isn't the point. The data the trade creates is the point.
Precisely. You have to look at the incentive. Most people in a market, whether it's a day trader or a huge fund, they're there to extract value.
To pull money out.
Exactly. NeoDataNet's argument is that they are trading to extract information. They're saying that in a digital market, the very act of execution generates this massive stream of high-fidelity data that a human trader could just never produce.
So they're effectively sending out these little probes into the market.
Yes. They aren't just trying to answer, did my trade make money? They're building a system to understand why markets in Africa behave the way they do. They're creating what they call a data moat for banks and regulators who are, and I don't think this is an exaggeration, basically flying blind right now.
And that phrase, flying blind, that's where we need to start, because before we get to the cool tech, we have to understand the problem they're solving. The source material describes the current African financial markets.
And that includes digital assets.
Right. It describes them as fragmented, opaque, and poorly instrumented.
Those are strong words.
They are. But what does that actually mean? If I'm a bank in Lagos, surely I know what the market's doing, right?
You'd think so, but not really. Not in the way that matters. Imagine you're a policymaker at a central bank. The tools on your desk, your risk models, your liquidity models, they're often what we call imported models.
So they're built for New York or London.
Exactly. They were built for those markets.
Which feels like trying to use a map of the London Underground to navigate rush hour traffic in Nairobi.
That is a perfect analogy. Think about why that map fails. The London map assumes fixed tracks, predictable schedules, known volumes.
A closed system.
A closed system. Nairobi traffic is organic. It changes instantly based on weather or local events. The imported financial models fail for the same reason. They assume New York levels of liquidity and behavior, and those assumptions just break under local African conditions.
So the data is delayed or it's incomplete?
Or it's just wrong. And when your data is wrong, your policy is wrong. You can't fix a currency slide if you don't even see it happening until 3 days after the fact. You need to see it in real time.
I love this line from their notes. They said, Africa is under-instrumented, not underactive.
That's such a critical distinction. People see bad data and assume the market is small or inactive. It's false. There's a huge amount of activity. Billions in mobile money, cross-border payments, digital assets. The engine is running hot.
But the dashboard is missing. The gauges aren't working.
Exactly. The instrumentation is missing.
And there's a lot of money on the table for whoever builds that dashboard.
Yeah.
I was looking at their market sizing. Global data and analytics is somewhere between 40 and 60 billion a year.
It's a massive industry, and the piece of that focused purely on trading and execution analytics is probably, 15 to 25 billion?
But here's the kicker. The Africa-focused slice of that is estimated at 1.5 to 3 billion.
A huge gap.
It's a massive gap.
It represents what they call the sovereign data gap. And their whole argument is that Africa can't just outsource its market understanding to, say, Bloomberg or Reuters forever. Someone local has to own that observability layer. If you don't own your data, you don't own your market narrative.
Okay, so that's the why. We need to get our eyes on the market. Now let's get into the how, because this trading as a sensor idea is fascinating, but I need you to break it down for me. You said a human trader doesn't create data in the same way.
Right. So let's run a quick simulation. Imagine you, a human, decide to buy some crypto or a stock. You look at a chart, maybe read a headline, you get a gut feeling, and you click buy. What data did you just generate?
Well, a transaction receipt, I guess. I bought X amount at Y price, that's about it.
Exactly. You get the execution outcome, a single data point.
Mm-hmm.
It tells us what happened, but nothing about the context. It tells us nothing about the why.
Okay, what am I missing then?
Well, did you record the exact market state at that millisecond? Did you snapshot the order book to see the liquidity above and below your price?
No, of course not. I just hit the button.
And did you log your decision logic? Did you write down, I am buying because the RSI crossed 70 and volume is spiking?
No, I'm probably not writing down. I bought this because my friend sent me a text message.
Right. And crucially, do you have a data set of what they call failure modes? Do you know what would have happened if you'd waited 10 seconds? Or tried to buy twice as much?
Oh, yeah.
An automated system generates all of that every single time. So for every trade, NeoDataNet system is logging 3 distinct layers of data. The market state, what the world looked like, the decision logic, why it acted, and the outcome feedback, what happened next.
So it's not just a trade. It's a controlled experiment.
Yes. And when you do that millions of times, you're not just looking at a profit and loss statement. You're building labeled financial data sets. You're creating market regime fingerprints.
Market regime fingerprints?
Yeah.
That sounds incredibly powerful.
Think of it like a topographical map. A human walking through a forest might remember, oh, there's a steep hill over there. A sophisticated robot walking through is building a map with elevation, soil density, wind speed, all in real time. It's not about the individual step, it's about mapping the entire environment.
And using the trade to stress test that environment.
To find the boundaries of the market.
Exactly. Which brings us to the structural edge. Because even if you ignore the data for a second, the math of automation here is, well, it's just staggering. They talk about time arbitrage.
The numbers are really hard to argue with. Let's just look at exposure. A dedicated human trader, a real professional, works what? 8, maybe 12 hours a day?
Yeah, if they're really grinding. 50 hours a week max before you completely burn out.
Okay, so that's roughly 30% uptime for the week. An automated system, especially in crypto markets that never close, runs 168 hours a week.
That's a 14x leverage on time.
It is. It's monetizing time in a market that never sleeps. While the human analyst is sleeping or at lunch or stuck in traffic, the sensor is still running. It's still mapping. It catches the things that happen at 3 in the morning on a Sunday.
And it's not just the hours, it's the raw speed. I think we all tend to overestimate our own reflexes.
We really do. We think we're fast. But a human reaction time to something on a screen, seeing it, processing it, clicking, is anywhere from 1 to 5 seconds.
Which sounds fast.
In the real world, it is. In electronic markets, it's glacial. A bot executes in 10 to 200 milliseconds. That's up to a 100x improvement.
Wow.
And that leads directly to something called slippage economics, which is basically a hidden tax on being slow.
Okay, yeah, break down slippage. The research treats it like a major cost.
It is a major cost. Slippage is simply the difference between the price you think you're getting when you click buy and the price you actually get when the order executes.
So I see a price of $100. I click.
Yeah.
By the time my order goes through, the price is now $100.50.
Exactly. In volatile markets, prices move violently. If it takes you 3 seconds to execute, the price might have moved against you by, say, 10 to 50 basis points.
And a basis point is 0.01%.
Correct. So 50 basis points is 0.5%. It doesn't sound like much on one trade, but their research shows that automated execution can bring that slippage down to just 2 to 10 basis points.
So you're saving maybe 40 basis points per trade.
Now, compound that. If you're an institution doing 500 trades a month, saving 40 basis points on every single one of them is a massive efficiency gain. It adds up. It's basically free money you're leaving on the table right now.
It's the hidden tax of being human.
It is.
But there's another tax, and this one is more personal, the psychological one. They call it behavioral drag, the human problem.
I think anyone who's ever managed their own money felt a little attacked by this section.
Right. They talk about psychological distress, but then they break it down into two specific behaviors that just kill returns: panic selling and revenge trading.
The two great destroyers of wealth and their biological responses.
What do you mean by that?
Well, panic selling is your amygdala. The market drops, your brain sees a threat, a literal danger signal, and you sell at the bottom just to make the pain stop. The data shows this makes drawdowns 1.5 to 3 times worse.
You amplify the loss because you got scared.
Exactly. And then there's revenge trading.
I have definitely done this. You lose money, you get angry, and you immediately place a huge risky bet to win it all back.
And you usually double your risk. You're on tilt, as they say in poker. The beauty of automation, and why this is a structural edge, is that code doesn't have an amygdala. It doesn't feel fear. It doesn't get angry.
It just follows the rules.
It enforces what they call structured decision-making under uncertainty. If the rule is sell, it sells. It just suppresses the behavioral error that causes most of the losses for retail and even semi-institutional players.
So we had the sensor collecting data, the edge from speed and uptime, and the removal of emotion. But this is where the story pivots again and gets really interesting. They aren't just selling this to traders.
No.
They want to sell this observability to the big guns, central banks, regulators, the African Continental Free Trade Area bodies.
This is the sovereign observability play. This is where it connects to the really big picture for Africa's financial future.
But why does a central bank need a trading bot? They're not trying to make a profit.
They don't need the profit. They need the intelligence the system gathers. Remember, the goal shifts from prediction, which is basically guessing, to observability, which is knowing exactly what is happening right now.
Give me an example.
Okay, imagine you're a central bank trying to defend your currency. Right now, you might look at daily closing prices. With this kind of infrastructure, policymakers can see what they call behavioral stress before it ever shows up in the price.
So instead of waiting for the currency to crash to know there's a problem.
You can see the liquidity drying up in real time.
Wow.
If you have 1,000 sensors in the market constantly probing liquidity, you can see when the market is becoming fragile. You can see if a policy change is actually working or if the market is rejecting it.
But wait, giving an algorithm the keys to all that data? Isn't that a huge risk?
It sounds risky, which is why they stress this concept of governed AI. This is not a black box doing whatever it wants.
Right. They list features like explicit policy constraints and auditable intent logs.
And human-in-the-loop escalation. It's designed for safety. But here's the really fascinating point for Africa specifically. They argue that technical governance is more important than regulatory paperwork.
What do they mean by that?
It's a very pragmatic view. In many of these markets, the regulations are still being written. There are gaps. You can't rely on a rule book that doesn't fully exist yet. But you can rely on code that enforces hard risk limits.
So the code itself becomes a form of law.
In a way, yes. It de-risks the whole jurisdiction for investors because it creates a safety layer that isn't dependent on a slow bureaucracy. It creates trust through technology.
That is a huge vision. But I have to play devil's advocate here for a second. Trading strategies. They fade. I've seen it 100 times. A pattern works for 6 months, then the market adapts and the edge is gone.
You are absolutely right. Strategies decay, and they know this, which is why they make this key distinction between the strategy and the infrastructure.
I remember this line. Strategies fade, but infrastructure is a permanent asset.
Think about it like a water treatment plant. The specific chemical mix you use to clean the water, that's the strategy. It might change over 10 years.
Right.
But the pipes, the pumps, the sensors, the building itself, that's the infrastructure. And that holds its value no matter what chemical mix you're using today.
So they're not promising alpha prediction. They're not selling a magic money printer.
No, and they're very careful to avoid that AI magic hype. They're not saying, we know the future. They're saying, we can answer structural questions like, in this market regime, how often does this kind of setup survive?
That's a very different promise.
It's the difference between a fortune teller and a structural engineer. The engineer tells you, if you put this much stress on this bridge, there's a 90% chance it holds. That's what they're providing.
They use a healthcare analogy too. Too many patients, too few clinicians.
Another great one. In a hospital, you can't have a doctor watching every single patient 24/7. It's impossible. So what do?
You use monitors, heart rate, oxygen sensors.
Exactly. They provide continuous observation when human attention is scarce. NeoDataNet is saying the market is the patient. The investors and regulators are the clinicians. This infrastructure is the ICU monitor. It beeps when something's wrong so the human knows where to direct their attention.
It's not about replacing the human. It's about giving the human the right tools to actually see what's going on.
And ultimately, it's about sovereignty. That's the word I keep coming back to.
Why is that word so important here?
Because if Africa is always relying on data feeds from New York to understand its own markets, it's always going to be a step behind. It'll be reacting to someone else's story. By building this data layer locally, they're reclaiming their own narrative.
It's a bold play. It's moving from let's run a trading bot to let's build a public-private research utility.
It completely elevates the conversation.
Yeah.
It stops being about speculation and starts being about critical national infrastructure.
So as we wrap up, let's just summarize the journey we've been on. We started with this idea of simple crypto bots, the whole get-rich-quick thing. But we've ended up somewhere completely different.
We've ended up at sovereign execution intelligence. We've seen how automation isn't just about speed, though the 14x time leverage and slippage reduction are huge. It's about generating a new kind of data.
Data that maps risk, removes our own emotional errors, and gives regulators the eyes they need to actually stabilize their own markets. It's taking the chaos and turning it into a clear signal.
Exactly.
The sources leave us with a really powerful final thought. They say, we aren't asking you to believe in a bot. We are asking you to believe in structured decision-making under uncertainty.
That's the core philosophy right there.
Because ultimately, someone must own the observability layer,
Yeah.
and Africa cannot outsource that forever.
That's the mission.
So here's the question I want to leave you with today. We often think of technology as something that disconnects us from reality, right? We're just staring at screens. But what if, in financial markets, technology is actually the only thing that allows us to see reality clearly? If your decisions are based on gut feelings and 3-day-old data, are you even investing or are you just guessing?
And if you are an entire nation, can you afford to guess?
That is the multi-billion-dollar question. Thanks for diving in with us. We'll catch you on the next one.